You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. Today is, of course, our Wednesday show with Zulfe Ali from Valerity. How you doing, Zulf?
I'm doing great. How are you doing, Buck?
I'm doing okay. How was the holiday? How was Thanksgiving?
Yeah, it was nice. We're a small family unit, so it's just the two kids came home from college, and my wife and myself. So it's a turkey for four, which means I'm still eating leftovers as we speak.
Yeah.
So, yeah.
Turkey.
How about your side?
Well, we don't do turkey anymore because my three daughters, none of them like turkey. So my ex-wife came over and we did dueling chickens. So she made a chicken, I made a chicken. Mine was on the grill, hers was more traditional. So we did chickens, and yeah, the girls had a good time. Kind of watched football, but I will tell you the games were interesting. You didn't watch any of them. I assume you don't even watch these games.
No, I gave up the habit.
All right. We won't talk about that then. That's fine. Okay. You're going to need to up your NFL ante here as we get nearer to the Super Bowl and the discussions on that. But
I agree, and I think gaming might be the way for me to build that interest. I was starting to think about if I start putting some bets down here and there, maybe that'll pull me back in at some point.
Yeah, there's a few things out there like FanDuel and stuff like that, and you can bet stuff and interesting. But okay, well let's start out with the recap of the podcast that was released earlier this week. You're not a tax guy necessarily, but any comments on?
No, well, yeah, I mean, I don't have a lot of comment on potential tax policies coming up, other than the fact, the stuff that you guys talked about, which hopefully will get, some favorable policies put in place, particularly on the real estate side with respect to bonus depreciation. Hopefully we'll see some of the, tax cuts that were from the 2017 policies get extended so that, we all can benefit both as businesses and individuals. But not a lot more. I mean, what I thought was also interesting was your prologue to the podcast on, your lessons learned from many years of investing. So I thought we'd chat about that a bit.
Okay. Yeah.
Might have, some thoughts there. I think your first lesson you talked about, quit while you're ahead.
Yes. Yes.
No bull run lasts forever. Completely agree. I did want to add some context to the way I kind of think about this. Because, generally I'm a pretty firm believer that most investors are going to benefit over the long term by staying invested. Right. So when you're in a,
I agree with that. I think my point there was more about staying in that particular asset at that moment.
Yeah.
Right. Anyway,
no, then it's completely consistent with the way I approach it. So the way to think about it, I think, is, as an investor, it's good to kind of upfront before you've deployed or, before you really kind of have all your investments out there, think about an allocation strategies. Think about how should I be allocated across the different asset classes to meet my investment objectives, to make sure that I am in line with kind of my risk profile, liquidity profile, all that kind of stuff. And that should help you kind of get into a very, let's say, a kind of a general target of different asset classes that you might come up with. So let's say hypothetically, an investor says, okay, based on my objectives, the returns that I want, the risks that I want to take, the liquidity I need, I'm going to go 40% of my portfolio in equities, 40% in real estate assets, and 20% in bonds, because this fits where I'm at. Now, obviously, it's going to be different investor to investor to investor. Well, let's say a year later, because there's been a tremendously strong bull run in the equity markets, the investor's portfolio has become skewed from that original allocation. And now we're at say 70% of equity. He's got 20% real estate, 10% bonds, because equity has just kind of overpowered. Maybe the other asset classes have slightly underperformed, whatever. But really the way to think about it is that your allocation strategy should not really have changed because you're still looking for the same investment objective, same risk profile, same liquidity challenges or needs and that sort of thing. So what it's telling you is it's time to rebalance, right? So just try to then take actions to take, your overexposure, the assets you're overexposed to, take those back down, sell, and reallocate to those assets where you are now underexposed. So in our hypothetical situation, you'd sell some equities, you'd buy more real estate, you buy more bonds. What's happening here is effectively kind of covering all of at least the first three lessons you talked about, which is quit while you're ahead. So by reallocating, you're kind of getting out of that hot market or are not remaining as exposed as you would have been. You're also,
because there's always something on sale.
That's the other thing. There's always something on sale. So something that's underperformed or where investors have not been chasing up, well, that's what you're going to rebalance back to, right? You're going to make sure your portfolio on a given day is going to allocate back to that. And then, your other point, again, being greedy is when others are scared. I think that's also very similar to the, something's always on sale.
Right. But here's the thing though, is a lot of that, what we just talked about, and I think your point about having a strategy up, in front, right, is important because it's really challenging, I think, psychologically, the way we're designed to do these things that I'm talking about. Of course, everybody reads these little rules and they're like, well, of course, everybody says that, but not everybody does it. I mean, you're literally looking at things in real time right now. People are not doing the things that we talk about. Why? Because it's never as exciting to invest in something that's beat up. I use the example in this case of, a private placement that I did in a uranium royalty company. Why? Because uranium is ugly. No one wanted uranium 3 years ago or 2 years ago or whenever that was. Nobody was talking about uranium. Nobody was talking about nuclear. Guess what? Now they are. In AI, it's probably the future and probably a good place to allocate over the next 5 years, uranium. I mean, I 10x'd on that. More than 10x'd in that placement. And it was because nobody gave a crap about uranium. It was for sale. It was absolutely for sale. And to the certain degree, and it's not anything like what the uranium situation, but I think the real estate right now is the same way. People are afraid. People are like, oh, there was a tough market with the interest rates and stuff like that. Well, guess what? The worst is behind us. I mean, I can't predict the future, but the reality is all indicators, the worst behind us. And like the major players here are all saying we've bottomed out, yet I'm not seeing a lot of people go back in right now. And now's the time when people really ought to be going back in. So.
Yeah, I agree. I mean, investment markets generally follow this herd mentality, right? Investors kind of all tend to chase the same assets at the same time. And then likewise, they tend to run away from the same assets at the same time as well. And so really what you want to try to do is be mindful of what's going on bigger picture and really do kind of the opposite. Unfortunately, the history of the stock market is, there's smart money that kind of does that, gets in quickly, gets in early. And then, there's the dumb money that kind of follows later and typically buys at the peak and sells when things are going down. And so,
and from a retail standpoint, I will say that that's a challenging place to be too, to recognize when you are in froth, right? It is pretty tricky because I remember even in the multifamily market, some of the major players that I like in the space who do a really good job, they stopped buying like in 2016, 2017 for the most part because they were like, oh, this market is way too frothy.
Right.
But the reality was there was still a good 5 years there or 4 years of real money to be made. So in the meantime, there was a lot of these people were out of the market for 4 years. And so that's the challenge.
And that is as big a risk on your investment performance to be out of a market than to be in a market and lose money because you can lose just as much money. The opportunity cost there for not being deployed in that opportunity is huge. I mean, people have been talking about this stock market being too overvalued for over a year, and here we are, 30% higher, and we're still going. And so, maybe maybe it's time now, but it's the same principle. You want to be kind of taking a step back and saying, okay, what is the exposure that I properly should have to these asset classes, and try to stay balanced over time on that.
So you don't like my Bitcoin rules? You didn't talk about those yet.
Yeah, well, the Bitcoin rules, I feel less comfortable talking about there. I mean, I do think there's been an institutional buy-in of that asset, and I think it's, my personal view is it is at the front end of what is being accepted pretty widely by all sorts of different types of investors. So I think there's room to continue to go there.
Yeah, I mean, you look at any these big institutional funds and stuff like that. I mean, some of them have already started allocating small amounts, but I mean, there's a lot of potential money going to still flow in there, especially with these ETFs and all that available. Yeah. And I've again, this isn't. This is when I'll kind of go out on a limb. Again, I still believe that until Bitcoin's, I'll try not to sell my Bitcoin until it hits the market cap similar to gold, which is, I think gold is about 14 trillion and Bitcoin's at about 2 trillion.
Yeah.
So we're talking still a seven-fold increase. We're probably talking about close to $1 million Bitcoin.
Yeah.
And it sounds, I mean, that may sound crazy, but let me tell you what, when I bought, when I was in Bitcoin in 2017 and it was going $3,000-$4,000, and I predicted $50,000 Bitcoin within 2 years, and well, that happened. Then my next prediction on this was $250,000 Bitcoin in the next 5 years. We're in like year 3 of that right now. Mm-hmm. So yeah. I still think it's probably going to happen. And again, this isn't because I think that there's something magical about Bitcoin. I think what I'm recognizing is kind of what you just said, that this is essentially a commodity, right? Like people are buying this like gold, right? And not because right now they're not buying it in the same mentality as gold. Most people aren't. They're looking at this as something that's speculative and that's going to go up. But eventually, you're going to end up with a market cap substantially, larger than it is today. And that is what's going to decrease the volatility, right? Then it becomes something different than just a, speculative play. I think most people who think of Bitcoin as a speculative play, I think, are out of touch with what's really happening. Compared to other cryptocurrencies, sure, there's a lot of speculative stuff going on there. Bitcoin, I don't think is any longer is a speculative thing.
Yeah, I think the more that it starts to kind of de-link its correlation to kind of the stock markets, I think that's needed as well, because if it really had its own trading patterns, I think it could become a really good, diversifying tool. But what we've seen largely that it tends to kind of go up and down with the general stock markets as well at this point.
But you know what the thing is, though, that even with gold, it doesn't really behave the way gold is supposed to behave. Gold doesn't seem to have the same kinds of qualities in terms of whether it's going up or down based on what you would think.
I mean, recently in particular, it's been a very different behaving commodity for sure. Right. I've been kind of confused by some of the price action as well, and I mean, we can talk about it a bit later. But I mean, it's up huge, right? It's like 30% year to date. It's phenomenal. Right. That's not what a commodity is supposed to do. That's not what a hedging instrument is supposed to do. So,
I just think the biggest issue with Bitcoin right now is the market cap's still too small, and that lends itself to volatility. And I think that's the biggest risk. If you're willing to just say, I'm going to hold this for the next 5 years, I think that's a completely different approach. And to me, if you're buying Bitcoin, that should be your approach, not the rest of other cryptos. Which, by the way, did you end up buying any of the stuff that I recommended, or you didn't?
I've stuck with my Bitcoin. I'm
Okay.
I'm not feeling that exotic.
Okay.
With
Yeah.
these other-
Yeah, no, that's all right. So just so you know, so Solana, which I've been talking about since it was at about $1.40, went up to about 250 something. It has come down. Well, now it came down to 218, 217 yesterday, back up to just under 240. I do think that's the big that is the workhorse of the ecosystem, and I still think it has a lot of legs. You know what else though? I want to just mention this because on the show, on multiple times, I have talked about another cryptocurrency called HBar with Hedera Hashgraph, and HBar went parabolic.
Oh,
and so went from like 5 cents to almost 40 cents within 10 days.
Wow.
Yeah. And there was a few things that happened that triggered this. One of them was an announcement from Canary Capital of an HBAR ETF application, which surprised a lot of people because it's not as well known as some of the others, but it sort of doesn't surprise me because it is so ingrained with a lot of the major companies in the United States and abroad, actually. Google, Facebook, or not Facebook, but there's a number like Tata Motors, all that. The other story there is that I can't remember his name, but one of the guys potentially up for the SEC chair in the Trump administration is on the board at Hedera.
Oh, okay.
And they've been working with the Fed and with some of this potential move towards Fedcoin and that kind of thing. So I'm not telling anyone to buy this, but it is an interesting story. So I'll tell you, I bought HBAR originally in 2017 in the pre-sale, and talk about convictions, okay? Because I literally held all of my HBAR that I had accumulated all this time since 2017, and it was selling, and it was like 5 cents, right? The day before the Canary Capital announcement. And I wanted to buy more Solana. So I sold half my stake in Hedera the day before.
Oh man.
I held it from 2017.
Oh, that's painful.
2017, within a day, I just, yeah. I mean, it's really just unbelievable to me. One day. So, anyway, I bought more Solana. I'm still a big believer in Solana. I still think it's gonna, I still think it's gonna be one of the biggest movers in the next few months. But fortunately, I had a fairly substantial stake in Hedera, so I'm still up. I'm still in. I'm not nearly as much as I was in.
Yeah.
And so it's something to keep an eye out. People have asked me now because we have a lot of people in our ecosystem who did buy Hedera when it was 5-6 cents. What I'm doing, I'm personally holding for right now. I'm not sure that I'm a buyer at this price though. I'm not sure I'm a buyer. To me, the way I think about this is I think HBAR is one of the most impressive platforms for actually doing anything. They're the only cryptocurrency out there that actually makes profit, and they're accepted by multiple, international major enterprise companies. So with that in mind, I anticipate it being a top 5 cryptocurrency. So by market cap, right now it's at about 12 or 13 billion. In order to get in the top 5, it needs to get to about 45 or 50 billion. So what I'm looking for is a big move towards that 45 to 50 billion. And if you get there, you're talking, close to, probably $1 HBAR. So, for me, probably what I'll do is like, once I get to about 60 or 70 cents, I'll probably put in like a stop limit and if it rides higher, then great. I'll keep changing that stop limit and probably write it down. But that's what people, I've had a few emails about that because there's a lot of people who bought HBar over the years with my conviction on this. But hey, no one's ever gonna, if you bought at 5 cents and, you're up, 7 times right now, don't feel guilty about selling. Right. So anyway,
sometimes that's the hardest part, selling.
It is. It certainly is. And,
crucial.
Yeah. So anyway, let's move back to, the real world, economy, markets. What's going on?
Well, we're watching, data for, expectations and what the future holds in terms of rate cuts from the Fed Reserve. So that's back in focus. There's another Fed meeting. The FOMC will conclude its meetings on December 18th and announce its decision one way or the other. Most people still think that that'll result in a 25 basis points cut to the Fed rates, but that the level of conviction is down versus before. It was almost unanimous before. It's now about, 66% chance of another 25 basis point cut. We'll have to see how some of the data that comes in before that point comes in, because there's some payroll data that'll be coming at the end of this week. There's jobs data that'll come at the end of this week. There's some inflation data that'll come in a couple weeks just before the Fed. So that will probably have an impact. But I unless there's some real crazy data that comes out, and even that I think would be taken with a grain of salt. I think it's just pretty sure bet that the Fed's going to take the current rate down from 4.75 to 4.5. And if you recall, we're coming from 5.25 in early September. So it's relatively material in terms of where we are.
So what are we waiting for between that time? What kind of data will be available to them?
Yeah, on Friday we've got the jobs report coming out. So that will be for the month of November. There's an expectation that, that's going to show about a gain of 200,000 jobs for the month. If you recall, October only showed about 12,000 jobs created, but there was a lot of noise there and issues in terms of hurricanes and other factors that probably, strikes and stuff like that. So that wasn't surprising that October was going to be, very, very low. If you go back to September, it was more than 200,000. So, it's expected October to come in at about 200,000, which is a strong number, but not a scary number. If it comes in, dramatically or materially higher than that, then that's something to consider, because, then it gives some pause on how cool or how hot the job market is. Obviously, the Fed wants, kind of a stable job market, but not too hot, because you don't want that pressure to flow into, wage gains and feed inflation. The other kind of data that will be coming, I believe next week, is going to be on inflation numbers. We had the last, CPI that came in, on October, the October inflation rating, showed a slight increase from September. And so people will be focused on how November looks. Now by slight, it's just a 0.1% increase. October went from 3.5% versus 3.4% in September. And so that was kind of holding steady in the mid threes. It's different from the PPI, which is kind of in the low twos, which is what the Fed really focuses on. And there's just different ways of
they focus on the PPI more.
Yeah, the Fed's favorite measure is PPI.
Versus CPI. Can you explain the difference?
Well, there's a different weighting of different items. The CPI is also it has a focus on urban areas, so it's really kind of just cities that they take some of the measurements from. Whereas PPI is a much broader kind of a gauge. It's not just urban. It's also suburban, rural, all that kind of stuff. So it includes a much broader swath of the population that they survey.
That's a huge disparity, though. Like, I mean, a whole 1% difference between CPI and PPI.
Yeah, well, and it kind of makes sense, right? You're seeing in congested urban areas, you're just going to have, some higher, items that are subject to higher inflation, particularly on the services, professional services. If you get all that kind of stuff done, that's where a lot of this inflation is coming in from. So I think those are, the big items to keep an eye out for at the end of this week and then next week ahead of the Fed's meetings. But again, barring any real surprises, I don't see why they wouldn't cut another 25 basis points. And then, then the real question is what's going to happen in 2025. We originally were, when the Fed started its rate cutting cycle, the expectations generally were that there was going to be another 4 to 6 cuts in 2025. I think the market is kind of backing up to maybe 2 more cuts in 2025 at this point, and waiting to see how things kind of shake out with respect to, some of the policies that the new administration is going to be putting into place, whether it's tariffs, immigration, tax cuts, large fiscal deficits, all those have a, kind of an inflationary impact. So, I don't think the market's necessarily freaking out that's all going to lead to inflation, but I think there is some kind of wait and see, and then on the margin, it sounds like it's going to be more inflationary than not. So there's, there is that sentiment going around.
What's interesting though is that the 10-year Treasury is actually down.
Yeah. Yeah, I'm with you on that.
Well, first of all, why don't you explain what that is, what that means, and why you wouldn't expect it?
Yeah, I mean, listen, I think, and we're talking about, from the time that, if you look at just before the elections, right, the 10-year Treasury spiked up right after it was clear that the Trump administration was going to come in, and it went up, I think, almost like 4.5% from 4.2, and really the feeling there was that immediate kind of, okay, Trump administration is going to equal stronger growth, which comes with more inflation. I think the early analysis of some of the policies that the Trump administration has been talking about seem like they're going to lead to larger fiscal deficits. So again, that's also that also weighs heavy on the treasuries, because you have to imagine that there's going to be appetite for investors to buy more and more and more debt, like we talked about on last week's podcast. So that also causes the Treasury yield to go up, because investors anticipate there's going to be a much more supply. I'm going to make sure I get a good compensation, i.e. a higher coupon for any Treasuries that I buy. And so the long end of that, that the 10-year gets more impacted, because it's just, more likely that some of these things will feed in over the longer term. The 5-year, less so, but still getting impacted a little bit.
So, why are you surprised?
But I'm surprised because treasuries actually have remained, have come back down from the time, that initially Trump was, announced the winner to now. And so
it's the Doge effect. The Doge effect.
I will believe it when I really see it. But
Elon Musk and Vivek Ramaswamy's Doge. We talked about it last week, but basically they're going in there with I think, what do they want to cut? Like, what was it? Huge numbers.
I think he said when he was asked, I think Elon said that there's two trillion that he thinks could be cut. I think the latest kind of communication out from them was that they think about a $500 million a year is something that they can cut. $500 million each year. So, which incidentally was relatively in sync with what your guest had said on a prior podcast in terms of what's probably the amount of waste,
lack of efficiency,
and all that kind of stuff. So $500 million a year, half a trillion a year is something that he felt was there for the grabbing.
And maybe they listened to the podcast. You think Elon tuned in?
The Doge committee is probably
I know the Doge committee's keying in on my interviews.
They are. They're looking for help. So I don't think they pay, but I understand they're looking for people.
Hey, you know what's interesting? As an aside, you know what the whole Doge thing is from?
Oh yeah, the Doge coin, right? What kind of dog is it?
So it's I don't remember what kind of dog, but the whole thing started out as a joke. And what's interesting about the whole Doge thing is the Doge is actually like identical to Bitcoin, like program wise. Okay. So programming wise, so it's it's interesting because it was a complete joke, but now it's like it's still kind of a joke, but it's like because Elon legitimized it so much, there's like places that accept Doge and merchants like that. So I would just, as an aside, I do have an allocation in the Doge world, because I can just see Elon going in there and I mean. He can joke about this. He can whatever. I mean, obviously, he's still, got it on his mind. He named the committee Doge. Yeah. Yeah. So I would just, I wouldn't be surprised to see Doge rocking it out here in the next year as crypto goes, goes crazy. Yeah. So
although would that not be competing with the Trump coin or whatever that's called? I'm not sure.
I don't think anybody's actually buying that. It's probably a meme coin, right? But no, I don't think anybody's buying that. No. I mean, it's not a real. I mean, it's I'm sure there's probably some speculative stuff there, but
yeah.
But the Doge thing that's already seen a big. It's Anyway.
Yeah. So I mean, listen. I think we keep an eye on treasuries because I think. The potential here is for a widening of the gap between the 5 and the 10 year. Right now, it's like 0.1% difference between a 5-year yield and a 10-year yield. Really, investors should get paid more for taking 10-year versus 5-year investment risk. Right. And so, that could easily have the 10-year going up by 40, 50 basis points. If again, investors start thinking there's more inflation or larger deficits coming down the road. But that's something we'll keep an eye out for and monitor. Other asset classes. I mean, we talked about Bitcoin. Obviously it's holding up pretty well at $95,000, and, we'll see if it tries to test that 100K mark. It's up 125% year to date. So that's a pretty darn good return. And as we talked about, gold as well, up 30% year to date, and it's holding up quite well. It's a little bit below the high prices that it was in October, but it's still amazing performance for the year.
So I have a question. Somebody, I had a friend who recently had a big disposition, a big chunk of money, and he all went into, at least for the time being, he went and did municipal bonds, just so he wouldn't get taxed on them, the income, from it, and I think he goes, and this was long enough ago where I think he still got like 5%, something like that. What kinds of, because I know you know a lot about bonds. If somebody's like sitting on a bunch of money and they want to do something, quote unquote, really safe, like how much interest can you get on various kinds of bonds that you wouldn't necessarily have to worry about too much? And obviously, I'm not saying that they have to be guaranteed bonds like U.S. Treasuries, but
yeah,
things that if you're looking at bonds, I know you like bonds. I think you once said that you're a big fan of junk bonds. Right?
I mean, listen, I like that asset class. I prefer to call them high yield bond, but we can call them junk bonds.
High yield corporate bonds. Right?
They are high yield corporate bonds. And the way you invest in them is a portfolio. You buy into a high yield bond fund, right?
Mm-hmm.
And that can generate yields of 9%, 10%, 11%. So you can get very high single digit, low double digit, and they tend to perform very well, and they're tested over many decades now in terms of performance, because at the end of the day, if you have a portfolio and you have any one particular company that just defaults or whatever, you're still doing fine, and that's kind of baked into that diversified approach. So, I think without getting into high yield, though, you still should be able to get, I'd say, these days 6-7% in a let's call it a low investment grade type of corporate portfolio. So you can pick up a couple of 100 basis points on top of treasuries by doing that, and still feel pretty safe at night. I mean, at the end of the day, you're at the top of the capital structure for these companies, and they are, it's not as volatile. It's contractual payments, interest payments, all of that kind of stuff. So
yeah, I guess the only bad part about it is ultimately, like, it's not tax mitigated at all.
It's not very tax efficient. That's one of the big problems. And obviously, your friend doing municipals is trying to do a different tax strategy there, because those are not taxable at the federal level. And so but at the end of the day, the coupons on those are adjusted, so you really don't get all of that savings.
Yeah.
The issuers assume that only people that are trying to save on federal taxes are going to buy these, and they kind of price them at a point where you get part of the benefit and they get part of the benefit. So
right,
yeah,
that makes sense. All right, well, talked about a lot of stuff. Anything else you have to add today? Or?
No, that's it on my agenda.
Okay,
so
great.
Yeah, we'll talk
all right. Well, good talking
week.
to you, and we'll catch up next week.
Thank you, Buck.
Thank you for listening to the Wealth Formula podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.